The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening to you. We should have you all live online and should be coming through clearly with the sound, so hopefully you've all got me. It's a stormy evening here in Johannesburg tonight, so should be fairly interesting. Wow, what a day. So we've all just found out that Obama is the new president. I'm going to go into that in a little bit of detail so that you can understand the implications of that and what is actually happening. It's interesting when you watch the markets. They talk quite a lot about what's happening in the markets and how, you know, they're quite topsy-turvy at the moment. I've just had to pretty much get out in New York. I literally left the day before that hurricane arrived. So, you know, that whole Hurricane Sandy and everything that's happened there. So we certainly live in some very, very interesting times. But what we wanted to do was to run this webinar tonight, and we want to welcome you all online. It's fantastic to have so many people online. We wanted to run a webinar tonight. It's our Let's Talk Property edition. We wanted to look at how do you get financing in American property. As you all know, I've just got back from America. I spent nearly 3 weeks there. We did 7 cities in that time, and we also attended, and I'm going to go into some details, some workshops with the leading businessmen and property investment experts. And so what I wanted to do tonight was focus on the fundamentals of finance. There's a lot of talk at the moment. There's a lot of emails being banded around South Africa as to what's possible and what's not. And I really wanted to decipher that and to give you the truth. And then I also wanted to give you a market update from what we've actually found on the ground in America. But before we get started on finance, we need to understand what has happened in America. Now, for those of you that have been on my webinars before, I will send you links afterwards to other webinars. I've done a number of webinars, a number of interviews on what's happened in the American market, where it's come from, why the opportunity is what it is, what the risks are. So I'm not going to go into that tonight because we've already got webinars that are on YouTube. But principally, I just want you to understand where the American markets come from, because there's 2 critical things that you need to understand so that you can actually appreciate where we are and where we're going. So the very first thing with America, the American market lost 40% across the entire country. And there were 2 major reasons for that. The first one was reckless lending. Now, what was the reckless lending? Well, these light purple graphs here were things that were effectively called fixed rate mortgages. They won 2- and 3-year fixes. And what actually happened was that the mortgage brokers would go to the average American and they'd say, listen, you know, we'll fix your interest at a very low rate for 2 to 3 years, and then the American would say, well, what happens after that? And they go, oh, no worries, we'll just remortgage for you. Well, we all know what happened. You know, ultimately, Lehman Brothers, this is Lehman Brothers going bankrupt here, because as the property market started to go the other way, as mortgages were no longer seen as such a great investment from the banking perspective, they would no longer refinance. And so what people did is their mortgages jumped from 2, 3, 4% to 8, 9, 10%, doubling and tripling in many instances. And these purple lines here were the residential mortgages, the reset mortgages, and literally the defaults. And you can see the billions in terms of defaults. And that's where Lehman Brothers was. Now, this graph's out of date. We've moved well into 2012. And something that's pretty interesting is the securitized debt coming through in the commercial space. So that's something that one needs to look at from a financing point of view. The second point of view with regards to America that is so important is supply and demand. So what happened is you saw this huge growth all the way through. Interesting enough, in about 2004, 1 in every 4 homes in America that was built actually remained empty. Why did they build them? Why did people buy them? Because capital growth was going through the roof. People didn't care about income. They were buying on 1, 2, 2.5% yields because all they were interested in was capital growth. They didn't care about negative equity or anything like that. But we all know what happened at the peak. And at the peak, it actually hit 10 million homes. 10 million homes in America were oversupplied. And we all know what happened in terms of the crash, and that's what I was talking about, the 40% drop. And then literally from about April 2009, it's kind of bumped along the bottom. But the bottom of the market, and it's very, very difficult to call the bottom of the market, and one tends to only look back in hindsight. But from all the research that I've done, from all the economists, from all my experience in America, I would say, and obviously again the market's very different. It's a massive country with 52 states, 300 million people. But if I was to just try and give you an overview, I would say the end of the market was the 3rd quarter of last year. The bottom of the market was the 3rd quarter of last year. And since then, the sentiment's come back in. investors have come back in, particularly cash investors. A lot of foreign investors have come in, and the market has started to uptick. And I'm going to go into that in a lot more detail. So that just gives you the background with regards to financing. Now, just so that you understand the reckless lending as well, there were things like stated income loans. So now what is a stated income loan? A stated income loan is where I want to buy a house for $1 million. So I go to my bank and they say, well, listen, if you want to buy a house for $1 million, you need to prove to me that you earn $350,000 or $400,000. So a stated income loan is where I just go, well, I do. Where do I sign? And I sign a little form and I say, I now earn $350,000. And the bank goes, oh, on the basis of that, thank you very much. We'll lend you the money. You can understand where that ends in a lot of trouble. They also had loans where, say, for example, my mortgage, in fact, one of the guys we deal with in Florida was telling me this. The bank actually approached him. His mortgage was like $2,000 a month. And they came to him and they said, listen, well, what would you like to pay? And he said, what do you mean? He said, no, well, how much would you like to pay? $500. And he said, yeah, obviously, I'd like to pay the least amount possible. They said, fine, we'll just put the rest on the back end. So you can understand with that type of reckless lending how they got into trouble. They said that, they had things like ninja loans, no income, no job, no asset. They would literally lend to anyone. It was pushed through by George Bush. Home ownership, the statistical home ownership is around 64, 65%. He pushed it up to 69%, forcing the banks, wanting the banks to lend freely because it was driving the economy in terms of where they were. And then we all know what happened. If all you needed was a heartbeat or be able to breathe in a mirror and have mist and you get a mortgage, that's what caused the reckless lending and the subprime crisis. But then the next stage was we had all the bailouts, and the banks were bailed out by the governments to the tune of billions and trillions. But the problem is that the banks were recapitalized, but they still didn't have confidence in the market. They still didn't have confidence to lend to the individuals or to small business. And the average American has what's called a FICO score. Now, a FICO score is like our credit rating here in South Africa. And the problem is that, this is obviously not across the whole country, but just the people I met, I would say about 8 out of 10 Americans that I've met have actually lost a property. Not necessarily their home, but lost a property. I've met guys that had portfolios of 350 properties personally that they lost. Because what happened in the go-go years is everyone got excited. Their FICO scores dropped dramatically, and their FICO scores are what are used with regards to credit. So everyone, well, not everyone, but a lot of Americans have bad credit ratings now because it was so easy to get into credit that they got themselves into trouble. They've also got a thing called non-recourse lending. So if a guy, was living in a house and he owed $500,000 and suddenly the house across the road was worth $250,000, he could walk away from his property. There was a thing called jingle mail where he could literally post the keys to the bank. And when they arrived, it was jingle, jingle, jingle because it was all the keys in the mail. So when you hear these type of stories, you can actually sit and you can understand where we've come from and why there's such problems with regards to financing. Because even though the banks have been recapitalized, they're still not lending to the man in the street. So it's time to do a poll. It's time to get you actively involved. Bank of America, I believe, is one of the biggest branded banks, and it says that in terms of America. So let's do a little poll here quickly, and I'm just going to select the poll. And oh, what's happened there? Just 2 seconds. I made a mistake with the polls. Well, just send through some comments. Actually, I'm pretty interested. Do you think it's possible to get financing in America? Do you think it's possible? Do you think it's possible to get financing from a bank? I'm very interested to see what you think in terms of whether it's possible or not. What are your thoughts? Come on, ladies and gentlemen. This is your time to be involved. If you look in the top right-hand corner, you can actually give me your comments. There's a couple here that says no, not from the banks, don't know, but because this webinar is about, there must be something there. Yes, for all, but you need to refinance after initiation by, can't see the poll. Steve, not from a normal bank. So it's just interesting. I really am interested in what people's thoughts are. I can see, Andre de Villiers, you've got your hand up. If you could just let me know how I could be of assistance. just send me through a question or whatever, and I'll be able to assist. So I can see there's a lot of people online, and a lot of people are saying yes, no. Some people are saying Bank of America, Buffett signed surety, I guess. Tried a year ago but wasn't successful. So it's interesting. There's been a lot of comments. So we've taken a poll. What I would suggest you do is actually go, and I will send you all these links afterwards. I've done a YouTube video outside the Bank of America, and it explains where we are with regards to bank financing and what is possible with regards to bank financing, etc., etc. So I will actually send you that link in terms of it. Now, just as my interest, Brendan and myself went along, and we actually went on a course held by Dr. Dolf de Roos. Now, Dr. Dolf de Roos is the author of Real Estate Riches. He's probably in the top 3 international investors. I know we've all heard of Donald Trump, but ironically, Donald Trump only invests in America, whereas Dolf de Roos has invested all over the world, from Asia to New Zealand to Australia to America. I'm not quite sure if he's invested in Europe, but for me, what's very interesting is he wrote this book many, many years ago. I read that book at the age of 19, and I attest a lot of my success in property reading that book because of the principles that were actually in there. Now, Real Estate Investor magazine and Dolf put on an event in America, and we actually flew over. We spent an absolute fortune, and we went to learn from Dolf. And while we were there, as a matter of interest, Dolf told us, now this man has an international portfolio. He has a massive balance sheet, and his FICO score is as good as you get. And he told us that he can't get financing. So, as a matter of interest, if Dolf de Roos can not get financing, and if the average man in the street cannot get financing, why do you think that us, non-residents, would be able to get financing? And on that basis, I want to tell you a funny little story. I went into the Bank of America 2 weeks ago to set up, open a new bank account, and the lady looked me straight in the eyes and said to me, "Are you an alien?" And I was like, "Pardon?" She, the term for non-resident there is alien. That's the way they look at us. So, again, if Dolf de Roos can't get financing from a bank, and the average American can't get financing from the bank, how the hell do we think that we will be able to get financing from the bank? Okay, so Steve has said here, Bank of America, for example, will give you a loan on property if you can show 2 years of rental income. So, that's exactly the point. And Steve, it's very well pointed out. So I challenge everyone, and I said to myself, right, what are the 5 ways that we can actually get financing? Because there are 5 ways to get financing in terms of how you actually do it, how you go about it in terms of what you want to do. So let's look at the first one. The first one is what I call weaving magic. Now, interestingly enough, there's a lot of emails being spread around South Africa at the moment, and I've got the email from many different people. There's a lot of people talking about it, about how you can buy a house in Atlanta, and you put down a 50% deposit, and you get 8.2% financing on the remaining 52%. On the remaining 50%, and et cetera, et cetera, et cetera. Now that sounds pretty good, but my belief in property, and it doesn't matter if it's property locally or international property, but it's even more important in international property, is there's only 2 things that you have to do to be successful. The first one is that you have to have the right information. And the second thing is that you've got to have the right partners. Now this year, we've spent over R750,000 flying to America, spending copious amounts of time in America, getting the right information and learning from the right partners. Now I wanted to explain to you how weaving magic works. Let me just talk about information and partners. This gentleman in front of you is a guy by the name of RJ. RJ is our partner in Atlanta, and interesting enough, this was a picture that I took when I was actually driving in the car with Brendan and Neil as we were driving around. Now, just prior to every month, they analyze about 5,000 properties. These are 5,000 properties that are being repossessed and are going to auction by the banks. They have 6 people working full-time, driving around looking at properties. 8 days prior to the auction, RJ gets a list like this. So this list that you can see in front of him here. He then vets those properties, about 300 properties, and he drives around 8 areas. So it'd be like Midrand, Sandton, Randburg, Pretoria, as an example. So 8 big suburbs, basically. and he then vets the properties himself personally. So this is a man, I mean, we've been in that car many times now, and on average we do between 30 and 40 properties a day. You have absolutely no idea how tiring it is to look at 30 or 40 properties and to actually drive around and look at them. And the interesting thing you'll laugh at is that he's looking at this piece of paper, and you probably think we parked on the side of the road. We're not. We're doing about 70 miles an hour down the road, because this man is an operator. He doesn't have a lot of time. He needs to vet these properties. And in August, we looked at 5,000 properties. He personally looked at about 300 properties. We went to the auction and we bought 16. So I don't believe there's anyone in the Atlanta market that knows more about the properties, the suburbs, the values, what's happening at the auctions, and the rentals than this man himself. The other thing that I was fascinated by is that when we get to the houses, often you can't get inside the houses. Well, this guy's not an MBA. He doesn't drive past, look, sit outside, do a little report, look on Zillow, and drive off. If he's going to put his money where his mouth is, he gets inside that property. And you'll see on other webinars I've shown you where he actually gets inside, and you can see why, because some of the houses are absolutely destroyed. This is a man committed, ladies and gentlemen. He has a portfolio of over 350 properties. He's been an investor for 35 years. He knows more about properties, one of the most educated, experienced, and nice people that I've met in American property. So for my whole philosophy of information and partners, well, what do? You go along to that property that was shown on the website, so this one, just for the record again, and you check it out. Because in America, or sorry, in South Africa, this looks pretty good. You know, nice little picture, return, etc., price, and I can get a 50% mortgage. But we go along to check it out. RJ and I drive up to the property. We take a look. I just want to give you some feedback on what we actually found when we were there, basically. Firstly, this property is in Clayton County, Atlanta. It's the worst county in Atlanta. Okay, it's actually lost its school accreditation. So if you ever want to get a good tenant, the number one thing that tenants look for is good schools. It's lost its school accreditation. So you're only going to get the bad of the bad that don't really or can't afford to live in a different area. It has a slanted driveway. You can't actually see it that much from this picture here. But I mean, our rental car actually got stuck. And it's a new rental car, got stuck getting into this driveway. It's got trees all over the house. It'll cost you well over $2,000 to trim those trees back and ongoing maintenance. It's got shaded shingle on the side, so this cladding on the side. And that's over 30 years old. It's got single pane, absolutely awful windows that would all need to be replaced if you're going to try and get tenants. And as RJ said, sometimes you can put lipstick on a pig. But in this case, there's nothing that you can do. Now, interestingly enough, the rent that he predicted, and again, he saw nothing. I didn't show him anything of what was being promoted in South Africa. The rent that he predicted was $650. Interestingly enough, if you look at the rent here, $775, $125 different. Do you have any idea what an impact that makes? It's about 2% on the yield, just to put in perspective. His exact words for this was that it's a ghetto. The problem with ghettos is that the only person that you can sell a ghetto to is another investor. You can only sell a ghetto to another investor that wants a discount. And the problem with these areas is that they might look good on paper, but they're very intensive with regards to management, and they hold very high maintenance. Yes, the yields look good on paper, but you actually have to get them. And he goes on to say that he even made a mistake when he started investing in Atlanta years ago. And he invested in Clayton County, although he never, as he said, went for properties like this. He would always go for brick houses. And he said he's learned that the best returns are in the owner-occupied neighborhoods. They're in the better areas, next to the better schools. And you've got to have the right property in the right area. And the reason being is that he focuses on safety. And so that's why he goes into those areas. Now, I've explained to you, the length that we go to, and it's all actually on this video here, and I will send you the link to this video. But what I think is so important is I've explained who RJ is. I've explained the length and the amount of properties he looks at every single month. And I actually said to him in this interview, I said, RJ, just as a matter of interest, again, without prepping at all, how much would you buy this house for at the auction? And on this video, he actually says, probably between $15,000 and $30,000. Only $30,000 on the upside, because the funds, and I'm going to talk about that a little bit later, have come into the market, and they're playing havoc in the market. And it's very interesting for me. So I said, oh, that's interesting. So $15,000 to $30,000 Now, just as a matter of interest, if I go back to what I showed you, this property is being offered in South Africa for 66,400. 66,400. And you know what? When I told RJ that in this video, he nearly fell off his chair. He said it'll never be 70,000 in 10 years. In fact, he said it'll probably never be worth more than 40,000. It was built prior to 1978, and that means that it's got lead-based paint, and it's a lawsuit waiting to happen. And how does he know? Because he is still being sued 15 years after he sold properties that he owned before 1978 with lead-based paint. So my point is, ladies and gentlemen, if this property is being sold at $66,000 here in South Africa, if it can be bought in America for between $15,000 and $30,000, surely you are able to join the dots of how people are weaving magic to provide financing. Because what they do is they ask for a 50% deposit, which pays off the house. They then ask for 8.2% financing on the remaining 50%, which is effectively you just paying off your same money over the next 10 years. It all comes back to information and partners. Now, if you want to go into that deal, go in. I have no problem with that, but go in with your eyes wide open. And I will tell you one other thing that I think is very important. We had 2 clients come on our buying trip now, and they independently went to check out other product in Atlanta, and without letting me know. And then they came on our buying trip. One did it before they came on the buying trip, one did it after they came on the buying trip. And I think it's incredibly endearing that both of them bought through RJ, bought his product. They actually said that this product is a very good advertisement for Adobe because it looks very good on the internet, but the suburbs are not good, the quality is not good, and by no chance does it stand up to the same quality, experience, and expertise that RJ is bringing to the market. So I thought that was pretty interesting. That's the first way. The second way is what they call private lending or hard money. Now, we in South Africa would even call that mezzanine finance. Generally, you're looking at about a 50% loan to value. There's a fee up front, generally about 5 points, which means about 5% of the mortgage. You're looking at interest rates anywhere from about 10% through to about 18%, generally about a 10-year amortization. The interesting thing is they do lend to non-residents or aliens, as they call us, and it's non-recourse, which means they don't worry about your own balance sheet. They lend against the asset. And I think that is absolutely critical in terms of where you actually are. And Yaku has said, I am an alien. So unfortunately, Yaku, we're all aliens, bugger. But what is very interesting is that you need to understand private lending because it can work for you. And I'm going to explain a little bit later. You'll see this house here. It's a 3-bedroom, 2-bathroom home. It's $85,000. And I'm going to show you how you can actually get a 50% mortgage on this house. It has a 21% net yield. And as long as you plow back the cash, you can have this house fully paid for within 3 years. So in those instances, it makes sense. But just now, I'm also going to share with you the questions you need to ask. Because if you're going to take private lending or hard money, you've got to understand that it's not coming from a bank. And you've got to be aware so that you can ask the right questions and you can make educated and informed decisions. The third way is that one of my friends from UCT is a banker. He's one of the top guys in New York, in Manhattan, for UBS, which is the biggest private wealth bank in the world. And if you have $10 million net asset value, they will lend to you non-recourse financing and non-resident at 3.5% fixed for 30 years. So for those of you that have got a lot of money in the bank and can prove that you've got that net asset value, absolutely amazing opportunity when you're getting net yields north of 10% and you can borrow at 3.5% fixed for 30 years. The fourth way is a way that one of my partners, Brendan, has actually done himself. And interestingly enough, he's done it from South Africa. I'm actually doing it from the UK. But that's where you borrow against your local assets. And interesting enough, if you do it right, you've got a trust in South Africa, and your trust in South Africa can lend to your LLC or your limited liability company in America, and you effectively set up a credit loan account. Now tonight, I'm not a tax and structuring expert. All I can do is tell you what we're doing ourselves, and I don't have the time tonight to go into the details with regards to tax. But the most important thing I wanted to show you was the benefit. So this particular house here is a house in Atlanta. You're looking at about $103,000, and I just wanted to share with you a spreadsheet and some numbers. So this particular property would rent out for $1,150. You would have a purchase price of $103,000. I don't have time to go through the full cash flow, but obviously with our clients, we always provide them with a full cash flow, so they've got no surprises in terms of where they are. And you'll actually see here that the property is really nice cash flow positive, over $8,700. And depending on what capital growth you want to work on, whether it's 3%, 6%, or 9.75. Now, interestingly enough, 9.75 is the 50-year average in America, sorry, the 100-year average. 3% is inflation, and property tends to track inflation even in downturns, and 6% is in the middle. Now, depending on where you're looking, I actually think in Atlanta, you should either be working on 6 or 9, because we've actually seen growth, much closer to between sort of 7 and 10%, even sort of quarterly, let alone yearly. But even if you want to be conservative, at a 3% capital growth with your yield, you're looking at 11.38% return. Now, that's if you bought that property cash in dollars. But as a matter of interest, what happens if I go out and I borrow and I'll refinance 100%? I refinance 100% against a property in South Africa. Now, we all agree that prime in South Africa is 8.5%. A lot of you will actually have prime minus a half, or prime minus 1, or prime minus 1.5. But actually, let's be conservative. Let's just leave it at prime. Now, leaving the exact same variables, don't you think that it's absolutely interesting that the property is cash flow neutral? So the rent that you're earning in America fully pays your bond at 100% mortgage. But what's fascinating now from a growth perspective is that your growth starts to go through the roof because you've actually got no cash in the deal. The next thing that I wanted to show you, which I also think is very critical. So don't you think that's cool? I mean, look at the size of that house, $103,000, and you're renting it out for $1,150. Between a 12 and 13% yield. The other thing that I think is very important is that we actually did a webinar last night. Now, James Painter is an expert that I've been working with since 2005. James actually uses a way called Elliott Wave technology. He's been doing it since 2005. He has a greater than 80% track record on where the rand is going. And for those of you who want to, get the recording on the webinar last night, he spent an hour and a half explaining how it all works. What I wanted to do, though, is that when you drive a car, you don't necessarily need to know how the car works. All you want to know is where the car's going. So I subscribe to his forecasts. Now remember, he's had an 81% accuracy since 2005. And interestingly enough, if you're going to buy dollars, the time to do it is in the next few days, because he actually expects the rand to strengthen in the next few days, to go from down to closer to between 8.6 to 8.45. However, in the next few weeks, it's going in one direction. It's weakening. The market will bottom out at 8.5 and is expected to go between 8.9 and 9.6. So that's the target area, 8.9 and 9.6 in the next few weeks. Now, if you're sitting and thinking to yourself, well, it doesn't matter, I'll just wait for next year. Well, unfortunately, you've got a horrible surprise. It's going to continue to decrease. The market has risen, so this is in the next few months. The market has risen strongly, and the initial 8.7 to 10 target area is expected. It's more likely to be between 9.5 and 10.4. 9.5 and 10.4 in the next few months. So kind of January, February next year, if you're thinking of waiting till next year, well, please just factor in a rand to dollar value of 9.5 to 10.4. And then the last one, which for me as a passionate South African is really sad to see. But unfortunately, the market is expected over the next few years to be between 14 and 20 Rand 50. So the only thing he's not sure of is whether it's going to be 14 or 20.50. But he pretty much 100% knows that it's not going to be 8.50 or wherever we are at the moment. So the point that I wanted to make there is that, and if you want to watch the webinar, from last night, go for it. But I think all you need to know is where the trend is going and the impact that will have on your wealth, basically, in terms of where you actually are. And remember, this guy's not just some economist or some guy that writes for the newspaper. This is all he does. And since 2005, he has an 81% accuracy. And my belief is that is good enough for me to at least follow, understand, and certainly take decisive decisions about. The other thing that he said is whenever the rand, once it starts to tank, it's over. There's nothing you can do. You have to make strategic decisions based on this information. And he had a lovely analogy of the Hurricane Sandy. He said, because of all the mapping systems, they could track the fact that Sandy was going to be a massive storm. And because of that, they could evacuate, most of the northeastern America. Now, it affected 60 million people in America, 20% of the population, and yet only 112 people died. But imagine how many would have died if they didn't have the forecasts and if people didn't take action based on the forecasts. Now, we're giving you the forecasts. You get to decide what you actually do with them. But as a matter of interest, the rand is devalued by more than 5% every single year against the dollar for the last 20 years. And when you start to look at the returns from a rand perspective, because remember now, you've taken the money out against the South African mortgage, you've effectively bought the property in dollars, but the rand dollar continues to devalue. I mean, my friend Brendan had something like a 25% increase just in his yield because the dollar to rand, the rand devalued against the dollar in the last year since he moved his money. Now, I know these numbers look ridiculous, and so let's go back and make it 0%. So you buy this property for cash. Even at a 0%, so if you're buying it in terms of dollars, your rand, so literally taking the money out of South Africa now, where would you be in 5 years? In 5 years' time, you add a 3% capital growth, you will have a 17% return on your money. So hopefully that gives you an idea of what is possible. I'm slightly different. I'm actually remortgaging against a London property. Same thing, same principle, because I believe I can get better growth there. One of the gentlemen actually earlier said one of the ways to do it is that you buy your properties for cash in America through an LLC. You start to create an operating account because you've got your income coming in and you've got your expenses going out. And after time, and interesting enough, I was going to try after 6 months, but someone tonight actually mentioned that it's closer to 2 years. But it doesn't matter. After a period of time, you go to the bank with your management accounts. And you say, right, I would now like to leverage against my vehicle. And then you can finance. But you've still got to make decisions now. You've still got to buy good assets now with cash or by remortgaging against, local assets. So my question is, and a number of you would have seen this, is do you actually use nature's laws? We all know that in nature, things work together. Yet as individuals, we always want to work separately. If one bird flying on its own in comparison with 25 birds flying in a flock, a bird flying in a flock can fly 70% further than a bird flying on its own. So my question is, why do you necessarily want to do it on your own? The fifth way to actually finance is through Wealth Migrate. And Wealth Migrate is a new concept that's been launched by myself and a number of my business partners, where it's a bunch of like-minded, sophisticated investors who come together, put their money together, and effectively have collective buying power. It provides us access to global property. We've got a huge plethora of expertise in terms of our best-of-breed partners. It makes it simple. You don't necessarily have to worry about the individual property and management and contracts and are they paying the rent and maintenance. It reduces the risk dramatically because you've got diversification, and it also provides you with a very low barrier to entry. It's not a fund. It's not a fund or listed property like Growth Point or Redefine. There are no fees. There are no fees in the front. There are no fees in the middle. It's not a syndication like Sharemarks or Blue Zone where they, you put in 100 Rand and they take 26 Rand in fees before you even get started. Why are we different? We have no fees. Our interests are aligned. We are co-investors. We are investing with you. In every investment, we get involved ourselves with our own money. We put our own cash in, and in principle, most of the investments are either cash or where we can fix a mortgage on a long-term fix where we can dramatically reduce that risk. And most importantly, there's complete transparency through our IT system so that you know exactly what the expenses are, what is happening. It's none of this. It's modern-day business nowadays, gentlemen. It's ethical business so that you know exactly what's happening. And as I said, in terms of the solutions, you've got the access through different knowledge. You've got simplicity. It reduces the risk. And from a minimum of $15,000, you can actually get involved. Now, just in my interest, what is actually involved? In America, we've got the residential and the commercial. On the residential side, we've got an income plan where we effectively buy property and hold it for at least a 5-year period. And then we've got the growth plan, which is where we buy it aggressively, we renovate it, and we sell it. On the commercial side, that's a joint venture that we're looking to do with Dr. Dolph de Roos, where we're buying commercial property and we're holding it for the long term in terms of where we actually are. But the exciting thing is, and why this is relevant to financing, is that the moment you buy more than 6 units in one building, so this building, as an example, in New York is 12 residential units, 3 commercial units. The purchase price on the entire building is $1.4 million. However, we can get financing on this building for up to 70% loan to value. We can fix it at 4.5% for 30 years. Now, I'm just going to repeat that. We can fix it for 4.5% for 30 years at a 70% loan to value. Now, we're not going to be as aggressive of that in terms of the loan to value. I don't think we'll go over a 50% loan to value. But by collective investment and by pooling and putting a number of investors together, we now have the ability to buy that building in New York, $1.4 million, and finance it with those awesome terms in terms of where you actually are. John has said, please can you explain what is meant by 80% accuracy on its own? That doesn't mean very much. John, I would ask you a favor. You're referring to last night's webinar. Please can you go and watch that webinar? He explains and he actually shows how he tracks the actuals versus his predictions over the time since 2005, and he's at an 81% accuracy. So, you know, he's 81% got it right in terms of where it actually is. Mark says, when will more info about Wealth Migrate be issued? Mark, I'll be letting you know tonight in terms of where we actually are. The growth plan, look, this doesn't have financing because the banks, you know, don't want to lend against single-family homes, even if we buy 20 under one LLC. But if you are interested, it's the opportunity to get involved in buy and flip. And, you know, the expected returns are about 25%. The expected returns on the income plan, you've got it depends on growth, but certainly a minimum of about 14% year on year. So I wanted to share with you some questions that I think you should be asking when it comes to finance. And this is so that you can't have the wool pulled over your eyes. The very first one, what is the value of the property and what is that based on? So what they're doing a lot is they're hiding stuff. They're putting in balloon payments. They give you 8.2% financing, but effectively you're putting down a 50% deposit that's covering the purchase of the entire property. So you need to understand that. Secondly, what is the rate? Is it a fixed rate? Is it a variable rate? Is it interest? Is it capital? You need to understand what is involved in that. What is the balloon payment or setup fee? There is always a balloon payment or setup fee. So if there isn't one, then know that it's been added to the purchase price. I believe it's far more important to be transparent so you know exactly what you're getting, so you can compare an apple with an apple and you can actually make a decision as to whether it's better to buy the property outright yourself. Yaku said, please would you share last night's webinar? I certainly will, Yaku. Is this fixed? Is this variable? As I said, what is the amortization period? Is it 5 years? Is it 7 years? Is it 10 years? Is it 20 years? And in some instances, is it even 30 years? You need to understand that. It has a massive impact in terms of the returns. How long is this for? You know, so what you tend to find is we've seen finance that was 20 years amortized, but it's not 20-year finance. It's only 3-year finance. And after 3-year finance, if you can't extend with them, you would have to pay it back in full. So it's a very important question to understand. What is the term of the loan? Who is providing the finance? Is it a bank? Is it a fund? Is it a well-capitalized fund? Is it just some loan shark? Who is actually providing the finance? Is this non-resident financing? Very important. Quite a lot of the things at the moment are they'll lend to Americans, but they won't lend to non-residents, or better known as aliens. Is it non-recourse? You know, I know it's not usual in South Africa because they always want us to sign all our sureties against the property. But in America, we have the ability to sign non-recourse, which means that they can only come after the asset. They're lending against the asset or the income on the asset, and it's great because you don't need to prove your balance sheet or your income from South Africa. And lastly, what is the loan to value and what is this based on? Again, it's a very important question. What is the loan to value based on? Because with all due respect, if they're giving you $35,000 on a $70,000 purchase that's only valued at $30,000, what loan to value are you actually getting? You've been told you're getting a 50%, but what are you actually getting? Because you've already paid off that property. And as a matter of interest, as I'll explain in Memphis, they don't even lend against the value of the property. They lend against the value of the income that can be earned on that property. So they take a 44-month view on the income that can be earned against that property, because their logic is if you default on the loan, they will happily take over that property based on the income that that property will earn. So those are the questions with regards to the financing. Now, I wanted to give you a market update and what relevance that financing has to the market at the moment. Now, I explained to you who Dr. Dolph DeRoos is, and as I said to you, Brendan and I went on a workshop. I'd made a huge amount of notes, and I just wanted to share with you some of the things that he actually said. He said, what happened in America is that interest rates went up, the lending got harder, there was less population growth, the developers got into a situation that they couldn't sell, there was then a massive oversupply, and then everyone went broke. Interestingly enough, though, in Phoenix, as an example, 2 years ago, there were 40,000 units, repossessed units on the market at any one time, and now it's down as little as 15,000, just to kind of put it in perspective. And the reason being is that people are coming from all over the world. They're seeing the opportunities, and they're actually coming in. If you're looking at, they've got a whole rating system in terms of the market. So you've got A plus, A minus, B plus in terms of the suburbs and the neighborhoods. You were looking at a 14 to 15% yield in a B plus neighborhood. Now you're looking at like an 8 to 9% yield in terms of where you actually are. He went on to explain in terms of that oversupply, there's a suburb in Phoenix called Gilbert. And at 1.4 years ago, there were 8,500 applications in for building. And 1 year ago, there was one. So what's actually happened is that the supply has completely dried up, but the population is still growing. Many people are still living with their in-laws, and because of this, the slack has been taken up. The inventory is being absorbed, and people are still moving into these cities. And because of this, you're starting to see this growth coming back into the market. In Phoenix, as an example, the market has grown anywhere from 6% to 10% a month. And I mean, what we've seen over since we were there 6 months ago has been phenomenal in terms of the growth. 30 or 40% over the last year that you would have actually made if you had invested. As a matter of interest, 34% of all investors who are investing in Phoenix at the moment are from Canada. Obviously, because the weather in Canada is so cold, they like the good weather in Phoenix. Now, he went on to say there's only 2 rent-controlled cities in America. That's New York and San Francisco, and they are limited because the rental can only grow by 3%. He says that Phoenix has the highest capital growth statistically over the last 50 years. That does worry me because it might have had that, but it's also had the highest capital growth, and it was also one of the 2 most worstly affected markets in terms of the crash. The worst affected market was Las Vegas. And interesting enough with Las Vegas is that it's landlocked. It's got the Bureau of Land Management on the one side, it's got an Air Force base on the other side, and it's got an Indian reservation on the third side. Because of this, land prices actually go up even more. But those 2 markets, although they had good growth, they're volatile because they had the worst decline. I mean, Vegas lost in the region of about 70%. We asked him about the elections, and interesting enough, we all know the result today, but he said it was a very pivotal election for America. He said that the recovery had been led up to the election, and that whoever won, it would be a massive step in the direction between capitalism and socialism for America in terms of what was actually happening. We asked about QE3, and he said the impact that it's going to have is that there'll be more money running around trying to chase the same assets. What that will create is more inflation, which will be very good for property, and both for property and for rental. And then he went on to say that maintenance is lower in Phoenix because of the weather. There's better stability in terms of the tenants because a lot of them are white collar and they work in call centers. And there's also a better mix of the tenants. He said there were 2 funds in Phoenix at the moment, one with $300 million and another with $400 million that was buying anything with a 7% yield. And finally, he said that Phoenix was the 5th largest city in the country. In terms of the airport, it has 1,200 flights arriving in the city every single day. 100,000 people in and out of Phoenix Airport every single day. And it's also one of the biggest areas where they bring stuff from the ports and then ship it out into the country. He thought that interest rates were going to remain low, certainly for another number of years. And the reason being is that, where the economics were, and there was no risk in terms of increase. They went into a lot of detail in terms of the different classes, and they said you've got upper class, which is your A plus, you've got middle class, which is your A minus, B plus, B areas, you've got your lower working class, which is your kind of B minus C, and then you've got your war zone, which is D. Okay, and we tend to focus on areas like middle class and lower working class. So kind of anything from A minus through to about C, C plus. We certainly don't like to look at the war zone in terms of where you actually are and what is actually happening. He spoke a lot about EB5 and the way to get a passport through property, remembering that Dolph is from New Zealand and has a New Zealand passport and actually moved to America based on his property and his property investments. So it is certainly possible. And again, tonight I don't have time to go into all the detail in terms of where we actually are, but in terms of EB5, I've done a number of things in the past to explain it, but if you are interested, let me know. He went on to say that you need to be very careful in terms of the fixing and flipping, particularly in Phoenix, because it's now a seller's market, and there's a lot of the margin has been taken, and it's far more of a buy and hold market in terms of where we actually are and what we're actually doing in terms of what we're looking at. One of the comments, one of the people actually asked him and said, what should I buy? Where should I buy? And he said, in a couple of years, it won't be the question of, what should I buy? Where should I buy? It will not matter what you buy. It's how many you will buy in this current market, because there's so much opportunity in terms of where you are. And then something I found very interesting is that he went a lot into depreciation. And just before I get into that, you can see it was a fairly small group, but these were all of us in Phoenix, a beautiful golf course. And there's Dolph there with Brendan and myself and everyone else that was on the tour. But interestingly enough, he went into depreciation and how you can depreciate the building, you can depreciate the contents, how apartments actually are better for depreciation because there's less land involved. And then someone asked him a question, would you invest in South Africa? And he said there's 4 reasons why he wouldn't invest in South Africa. Firstly, the sagging currency. I've already explained to you in depth about the sagging currency and unfortunately where we're going in terms of what is actually happening. Secondly, he said, well, we don't have any depreciation in South Africa. So we can't depreciate assets like we can, which makes a huge tax benefit in America. Thirdly, we've got restrictions on getting money out, and you know that we all deal with that, and yes, they have relaxed it, but there still are restrictions. A lot of my clients are moving money from South Africa, and it's a huge hassle. I'm moving money from London, and it can happen, at the click of a button, basically. And the other reason is in South Africa is that we can't fix interest rates, whereas as I've already shown you in America, we can actually fix interest rates for up to 30 years. The biggest risk in property is if you're on a variable interest rate and interest rates go up. But imagine if you can fix it at 4.5% for 30 years. It eliminates the risk when the property has a net yield of 14%. Now, Gary has said, if you look at property in Phoenix and Atlanta and the correction, these areas corrected back to the pre-bubble levels, what about the rest of the country where values are still far from high? QE3 cannot increase the economy if demographics are against recovery. If QE3 fails, then what will the opportunities as the system crashes? Gary, I completely agree with you. What I believe is the most important thing is replacement value. So if you take an area like Atlanta, if it costs 100 Rand to build a house and I can buy it for 50 Rand, then I'm sure you will agree that that is the most important component. And the second thing that you need to look at is the income and the yield that I can get. So I am not one that looks at capital growth. The biggest lesson that I learned from the financial crisis is that anyone that focuses primarily on capital growth gets themselves into trouble. It's like betting against winter. At some point it will come. But those people that focus on income, that buy themselves good assets with good income, they can ride the wave. So whether QE3 works or doesn't, whether Obama makes a difference now that he's in and Romney's not, it doesn't affect it. And as you say, some markets have improved more than others. That's right. Our ability and our focus is finding the markets where we get the right information and have the right partners on the ground. So let me just show you some examples because I think this will sum up what Gary's actually asking. In Phoenix, this was the best property that we saw, in my opinion, in Phoenix. I'm trying to compare apples with apples for you. This property was $143,000. It rented out for $1,050 per month, which is a yield of 8.8%. It was a 3-bedroom, 2-bathroom. Now, my opinion of Phoenix is that the Phoenix market has run and it's run too fast. We saw properties, the market has gone up significantly since April, and over the last 6 months, as I said to you, it's gone up by 30-40%. My problem is that the rental yields have not kept up. And when you talk to the people on the ground in Phoenix, they're constantly telling you, oh, don't worry, you know, this is a capital growth play. This is a capital growth play. If you buy this, it's a capital growth play. Well, that completely goes against my investment philosophy, because just like Gary said, that's betting. That's betting on the future. You don't know what's going to happen with QE3. You don't know what's going to happen with population or job growth or anything else. So for me, I didn't like the yields, and apple for apple, I believed I could get better value in other areas. What I did like in Phoenix, and this came through Dolph, was a shopping center. So you can see the shopping center here. It's got 2 big electronic billboards, and there was a strip mall all the way through here. It had 9 shops in it, so effectively 10 tenants, because 9 shops and the billboard. And very interestingly enough, this was a C-grade building, so it wasn't Menlyn Shopping Center by any measure, but this is the main road between Phoenix, and it's the old main road between Phoenix and Vegas. The price on the shopping center was $450,000, and it had a net yield of 18%. It was fully tenanted. The shortest tenant that had been there was 2 years. The longest tenant was 6 years. We've got the entire rent roll. And the fascinating thing here is that we can finance this 4%, loan to value of 50%, fixed at 4% for 5 years. If you want 7-year money, it's fixed at 4.5%. So it's a little bit more aggressive than residential financing, but we can get 50% loan to values fixed at 4% on 5-year money with an 18% net yield. And again, a partner on the ground that knows how to operate, knows how to manage, and can look after the property. Then I just wanted to chuck in this particular property. Dolph took us to it in Vegas. It looked absolutely awesome. I know it looks from the picture like it needs a bit of wear and tear, but from the price, it was $50,000, ladies and gentlemen. A 4-bedroom, 3-bathroom, 260 square meters. It seemed too good to be true. And often things, when they seem too good to be true, are basically. We actually went up and I spoke. There was an old gentleman there that I went and spoke to, and his son had been renting there. And you can actually see all these carpets here. And the reason being is that this property borders onto a golf course, which has a big retention river that runs through it. And in the last 6 months, they have been flooded twice to 1.5 meters, so about that height, and the house has been absolutely destroyed. And that is the biggest reason I believe that you cannot buy anything on the internet. You've got to have information and partners on the ground, because you could have bought that property, it might have looked like a fantastic yield, and then come the next floods, you would have the same problem that the current owners had with this house being decimated, and nothing's going to change. It's next to that golf course. There's no way of stopping this house from flooding. The thing I did like in Vegas was that you're looking here at this townhouse complex. It's a 3-bedroom, 3-bathroom, $69,000, $925 a month rent, which is a 16% yield, really good value. It was coming through one of the wholesalers that Dolph DeRoos works with. My only concern with Vegas is that more than 50% of the market in Vegas actually works for the tourism industry. Now, considering that the tourism industry has gone down 65%, so there used to be about 50 million visitors that went through Vegas. Now the airport has about 30 million. Unemployment is highest in Vegas than any other state in Nevada, any other state in America at 13%. And there were a huge amount of people moving to Vegas. But because the construction industry has been completely decimated, that is why it's got such high unemployment. And with the tourism being, so low, it has a major, major impact. I mean, as a matter of interest, MGM, which owned 3 of the biggest hotels on the Vegas Strip, actually last month lost $150 million. Now, a completely interesting stat for me is that 20% of properties across the whole of America are actually underwater. So that is where the value of the mortgage is higher than the value of the property. But in Vegas, it's 60%. So are there opportunities in Vegas? Yes. Are the risks higher? Definitely, because they've only got one major industry, and that industry employs more than 50% of people, and that industry is very volatile and very susceptible to the strength of the economy. Gary said, if I look at many of the property examples that IPS has presented, they are well outside the city areas, to the degree quite rural, as a kind of these properties, not a risk in the downturn. So interesting one, Gary, in terms of the location. The one thing with the American cities is that they don't, it's not like South Africa where everyone wants to live around Sandton or Menlyn or Century City or Cavendish. They're much more spread out, and it's very similar to Australia, where the people are happy to live out there. They've got the schools out there, they've got their employment out there. So we tend to as I said to you, we focus on the homeowner neighborhoods. You know, it's not right on the doorstep of the CBD. And why? Because we're focusing on that working class and that upper working class, you know, people, that B plus, A minus neighborhood that I actually spoke to you about, that middle class and lower working class. And it's very important who we're focusing on and the rental demand. And you know, Gary, I've done very well in London property, and I never bought in Knightsbridge, ever. I always bought in Wimbledon, which was Zone 3, Wimbledon, South Wimbledon, Earlsfield, Putney. Those areas that are kind of the secondary areas around the financial hubs, in the good areas where people can go to good schools, there's good shopping, there's close to work. Those are actually some of the strongest areas because they're not susceptible to the high flyers. It's not the Manhattans, it's the New Jerseys. And really, that strategy has worked extremely well for me, especially because you focus on income, you get higher yields, and they're much more sustainable yields that you can quantify. Then you've got Atlanta. I mean, if you look at Atlanta, one of the things that I love about Atlanta is the replacement value. If you take this house here, it will be well over $200,000 to rebuild this house. It's generally about $100 per square feet, and this house would be well over 200 square feet. But you're buying this house at $102,000. You're renting this house out for $1,100 per month, which is a yield of 12.94%. As I said to you, the replacement value is over 200. It's a 4-bedroom, 3-bathroom home. And yes, as Gary said, they're in the suburbs. But the most important thing is that they're in the homeowner suburbs. They're not where other investors are. They're not in the ghettos. They're not in that C grade like I showed you earlier when people are weaving magic. They're in homeowner neighborhoods. And I can't say any more than the fact that we've just had 12 investors come on our buying trip. Every single one of them was blown away by the quality of the areas, quality of the product, quality of the expertise of the partners on the ground in RJ and Anthony, etc., etc. And nearly every single one of them invested in Atlanta, in these properties, in terms of what was happening because of where they look. So to answer your question, and Gary, if it's something that concerns you, that's fine. But please, come along on a buying trip. Come and experience it for yourself. I find it incredibly endearing that the people who actually came and put their feet on the ground understood the opportunity, understood the demand, understood what was happening in terms of the market, understood the rental demand, and were willing to commit now so that they could get involved in the opportunity. The challenge that we've got, though, is that there's equity funds. People understand what's happening in Atlanta. They understand the value. Inventory is extremely low. You know, when I was at the auctions in August, John Chin told me that there were 30% more people that were there than the auction before. And the time before that, there were 30% before that. I've been there. They have these sophisticated buying teams that are actually there. And if anyone thinks that they're naive enough that they're going to rock up at the auction and actually find themselves a deal, they're just being damn right stupid, actually. And I'm sorry, there's no better way to say it. This was actually an article that you can see here that was in the newspaper when we were in America. It was in USA Today. And it actually spoke about Atlanta. It said the big hedge funds are willing to spend and buying up single-family homes. Two Harbors Investment Corporation is spending $150 million this year in terms of entering the market. Colony Capital has already bought 130 houses at the Atlanta auctions in October and is aiming to buy 3,000 homes in terms of where they are and own between 15,000 and 20,000 homes by the end of 2013. Now, they are aiming at investing $1.5 billion. And the interesting thing is that our partner on the ground, RJ, has already sold them 18 properties and actually has an open mandate with them to buy anything. Now, you must understand what that's doing to inventory. You must also understand what that's doing to rents in the short term. But that's why we've got such good partners on the ground, because they understand that if you don't, it doesn't matter what discount you buy something at, if you don't have a tenant, then you don't have a property investment. And so they are investing over $10,000 a month in marketing to get tenants. They've got an amazing way of actually doing it there where they've got a rent-to-buy option. So you get tenants in on 3-year leases, basically. And even though 95% of them don't take up the option, so it's not a guaranteed exit, it gets people in that want to be homeowners. It gets stable people, and that's why we go for homeowner areas, because we get stable people. It's safety, ladies and gentlemen. It's blue chip. It's safety. It's everything that you want. It's wealth preservation. It's a plan B. It's peace of mind in terms of where you actually are. They've got a whole lot of incentives at the moment with other property managers, etc., etc. But that's why I'm investing my money in these type of people, because they're experts on the ground, they know what's happening, and when the market's changing like it is at the moment, they are willing to adapt and make it happen. Yaku said he loved this area, so Yaku, thank you very much. Yaku was actually on our trip and really loved this area and has actually invested there himself. Sally said, what are the costs like all your residential examples are gross yields? Surely we should look at net yields. Sally, that's fine. I've got full cash flows and I can send them all through to you. But you're looking at net yields of, depending on the property, in particularly Atlanta, say 9 or 10%. So you can take off probably 2.5% for the expenses. But you know, for the purposes of tonight, I've got all the cash flows and I can take them through, but please get hold of me and I can take you through. Vikesh says, can you please explain a bit more about the buying trip before the conclusion? Vikesh, I'll do that just for you, basically. Orlando was an interesting one. In Orlando, we focus on condos, or what we South Africans call apartments. So this was actually the condo up here, and it was actually bought by one of our clients on the trip. The purchase price was $68,000. The rent is $850 a month. The yield is 15.22%. It was sold about 5 years ago for $140,000. It's much harder to do replacement value in a condo, obviously, because it's like a sectional title building like we've got in South Africa. But it's a 2-bed, 2-bath. And the interesting thing for me with Orlando, there's a pro and a con. Yes, you're at a better entry level because of the prices in terms of the condos. The only downside is that you've got homeowners associations. And the homeowners associations are like body corporate fees. Now, if a property used to be R1 million, and if it dropped to, in South Africa, we always know that body corporate rates are generally about 0.1%. So if you have a property that was R1 million, you'd pay R1,000 a month. Now, if the market dropped to 500,000 Rand, would the body corporate rates drop to 500 Rand? No, they wouldn't, because the expenses are the same. The salaries are the same. The electricity is the same. The water is the same. The maintenance is the same. And that's why the homeowners association fees tend to be high and do affect the net yield. So it's something that one has to consider when one's comparing in terms of the net yield, the positives and the negatives. Every area has positives and negatives. In Atlanta, there's no finance whatsoever. The reason being there's so much demand that the only way to secure good properties is to buy them cash. That's the way it is. Gary said, I have a number of properties in South Africa and find managing agents is a bigger problem than tenants. How would this be different in America? Very interesting. Look, Gary, at the end of the day, management is always difficult. I say that buying property is 20% about buying the property and 80% about actually managing the property. And that's why I say you've got to have the right information and the right partners. Now, the guys that we've partnered with, it's a long story, but I've worked with a guy called Rod Thomas since 2005. He's been helping British and Irish investors invest in America for the last 6 years. He's helped 1,100 investors invest. So when I went to invest, I didn't just start from scratch. I've worked with him for over 7 years. I went and I met his partners. So not only are our partners on the ground that find the property, they renovate the property, but the guys that manage and maintain the property have been working with international investors for 6 years. They've got a portfolio of over 1,100 properties. No management agent is perfect, I'll give you that. But we have found the best of breed on the ground. They've all got electronic systems so that you've got real-time communication. And look, at the end of the day, I'm not going to sit here and say that anyone's perfect, because they're not. But the point is that you have collective buying power. So in an instance, we had a problem at the moment with one of our managing agents, and we just moved our entire portfolio over to another company. And we've got much bigger buying power because we collectively are coming together, us and the British and Irish investors together. So then you've got, and one thing about Orlando that I like about Orlando, Orlando has Disney World. Disney World employs over 100,000 people, but it's the antithesis of Vegas, because Disney World was opened in the early 1970s. It's always had 100,000 people through the gate every single day. It has not been affected by the global financial crisis. The airport this year had 52 million people through. At the height of the crisis, the GFC, it had 49 million through. So it's very interesting because it's family tourism. You know, Vegas is a luxury, whereas Orlando is family. Plus you've got the international tourists. And those 100,000 people, they are the people earning $30,000, $40,000, $50,000, and they are the people that are renting in these type of condos. And that's why we always buy in good locations, close to good schools, close to good transport, so that they can get to their place of work, be it downtown, be it at Disney World, be it at Universal Studios or SeaWorld or any of the places of employment. And then Memphis. Memphis was absolutely fascinating when we went there. Memphis is a very high yielding area. The capital growth in Memphis, historically for the last 30 years, has been 4%. So it's never had a big up and it's never really had a bad down, basically. It's more of a rental city. Interestingly enough, more than 50% in Memphis actually rent. But there's only, we deal with some really, really top people there. A guy by the name of Hewlett, Marvin Charles. And Hewlett actually said to me, he himself owns 100 properties in Memphis. And he said there's only about 60% of the city that he would invest in. And he gave us all the areas that you would look at. Things like Germantown and Collierville are really nice areas where you're getting high rents. They want to focus on A, B, and C plus in terms of the areas. And the rentals that you're looking at there are anywhere from about $1,500 through to about $750, $800. Now, as a matter of interest, this particular house in front of us was $85,000. It was a beautiful house in an estate, brick built, and it was $85,000. And for Gary's purposes, it was right opposite a big school. It was right in the commercial center, and it was in that area of Collierville that they mentioned was a really good area. The interesting thing with Memphis is look at the yields. The rent, $1,500. That's a yield of 21.18%. It's a 3-bedroom, 2-bathroom, standalone home. And the fascinating thing here is that there's a fund that is lending, and they're only lending to the guys that we're dealing with in terms of our management company. They're one of only 4 companies in the whole of America. And the reason being is that they are lending against the income stream on the property. So the loan to value is actually worked out on 44 months rent. Again, it's non-recourse, non-resident financing, because they're not worried necessarily about who you are, and they're not even necessarily worried about the value of the property. They're worried about the rental income stream. And what I think is incredibly endearing, and Gary, I think this will be quite important for you as well, is that they're lending to this particular management company because this management company is good at collecting the rents. And they know that that gives them security of income, which they can then justify being able to lend. So they're lending generally about 50% loan to value. And this property is based on comparative analysis in today's market is 120. Now you're going to say to me, how can I buy a property for 85 that in today's market is 120? Well, my question is, if you go along to the auctions and buy repossessed properties in South Africa today, can you buy stuff at below market value? Of course you can. So that is what is exciting about Memphis. And just to give you a quick cash flow, and hopefully this will answer some of your questions for cash, but you're buying this property at $85,000. Its estimated current market value is $120,000. Your down payment, your 50% payment, is $44,625. Your closing, and it's a little bit more than 50% because it's got the costs. You've got the closing costs, that's your lawyer's fees. You've got your insurance premium. So this amount here in terms of the low down payment, that has your that upfront fee. So again, whether you buy this property cash, it'll be $85,000. And if you buy this property with finance, it'll also be $85,000. Complete transparency, which is our motto. Insurance premium, so that, I mean, you would buy that if you got any property, which is helping you from a cash flow, but you've got the insurance for the year. The annual rent is $18,000. The operating expenses are $4,400. Generally, you work on about 10% of the income is what's earned in terms of management. Funny enough, in Memphis, it's slightly lower, but anyway, I just want to keep you. The debt servicing is $6,700. The net rental profit is $6,800. Your net cash on cash return is 16%. And I don't really want to do projections over 5 years because, as I said to you, I'm interested in the income. But for those of you who are interested in the capital growth, you're looking at like $117,000 over 5 years, which is a $34,000 profit you'll make $34,000 in rental income profit. So your total profit will be $106,000, which is a return on investment of 239%. And what's very, very interesting is that we had 2 clients actually come on the buyer's trip. One of them was an engineer MBA, which is actually more difficult than a CA, and the other one was a CA. And interesting enough, they went home, and while we were sitting on the plane from Memphis to New York, they number crunched, and they worked out that if you buy one, they'd already bought each one house in Atlanta cash, and they worked out if they buy 2 houses in Memphis, 2 houses like this with this type of example, and they reinvest all the income from the Atlanta house and from both Memphis houses, both Memphis houses would be paid off cash within 3 years. So the benefit is, if you embark on a strategy, and Brendan actually did the same maths without even knowing it because he wasn't here with this part of it, and he did the same maths, and on a 1-to-2 basis, if you buy 1 in Atlanta and 2 in Memphis and you reinvest everything, you'll own everything cash in 3 years. And like someone said earlier, you would then be able to go back to the bank because you'll do it all within your LLC, you'll have your management accounts, you'll have your trading entity, and then you could go back and actually refinance properly from a bank like the Bank of America in terms of where you actually are. And then finally, New York. Interestingly enough, with New York, I like New Jersey, which is funny enough the area that got taken out the worst with regards to it. Luckily, we focus on an area called Journal Square, which is actually higher up. Hoboken is lower down, which is where a lot of you would have seen those yellow taxis all underwater. There's 2 types of investments there. There's these multifamily residences, where you buy a building like this. So this building here would be a 3 multifamily, so it would be about $200,000. A 2 multifamily is about $120,000. A 4 multifamily is about $250,000. You're renting out each family unit for between $1,000 and $1,200. So depending on the size of your building, you can get really good yields. The downside with New Jersey and New York is twofold. One is there's no financing, so it's quite a heavy capital outlay, and all your money is in one property and not necessarily diversified. And the other one is that there's an Australian fund there with $135 million, and they've bought over 130 properties over the last couple of months. And so obviously they've had an impact on supply and prices in the market. And the one that I'm most interested in, and the market that's not really being focused on at the moment, which is fantastic, is where you go and buy buildings, anything over 6 units, like the one I've already shown you, because we can then finance it. So this particular building was gutted by fire. It was $400,000 and $450,000 purchase price, $900,000 renovation. All in with all fees would be $1.4 million. We would buy it, renovate it, tenant it, and then we could go and finance it. And just to remind you, 4.5% fixed for 30 years, with the loan to value being as high as 70%. So for those of you who, and I know tonight is a lot of information, if you want to go, there's a market update. I always do a market update. Unfortunately, it's not in Times Square. I did start a tradition many years ago, but with Hurricane Sandy, I had to get out of New York pretty quickly. I managed to get out the day before they grounded 12,000 flights, and only by using a bit of South African persistence, because I was supposed to be staying in New York to meet my financier. But if you want to go online, you can actually go there and get our market update, which I've explained all the cities, and I've gone into depth, and it's on YouTube in terms of where you actually are. So in conclusion, the next steps are, if you're interested in direct property, someone like Gary who's got a lot of questions, please, which is fantastic, please give us a call. Let's set up a meeting. We can send you all our research. We've got an ebook, a 72-page ebook on the market. We've got investment documents on all the different areas. As I said to you, Brendan and I have spent over $750,000 Rand. Teresa and Relene have just been over as well. So the whole team is very experienced in the market. They've been there, they've seen it, they've touched it with their own fingers in terms of what is actually happening. And use that experience. They've been there, they've met the partners. And as I say to you, they've met the partners and they've got the right information in terms of where they actually are. Mark, I don't understand your question. You said that is more than $1 million per property the Aussies spend. If you could clarify on that, I'm not 100% sure. The other way to get involved is Wealth Migrate. I've already explained to you, we've already opened up the income and the growth fund. I'm still finalizing things on the commercial side with Dr. Dolph de Roos. If you are interested, you can get hold of us now. Everything is open. The bank accounts are open. The lawyer's trust account is all open, and we will be closing that on the 23rd of November. So if you want any more information, we now have everything set up. We've done all the work with Grant Thornton in terms of the structuring, the tax, the compliance, both from a South African and from an American perspective. If you don't know who Grant Thornton are, they're the 5th biggest accounting firm in the world, very big in America, very big in South Africa, and they've looked at all our compliance and our structuring, and we will be closing that on the first tranche on the 23rd of November, which will allow us time to get in the market and take advantage. We've got a number of opportunities lined up in terms of where we actually are. Then the USA buying trips, someone actually asked me earlier, I think it was Sally or Bakesh. The buying trips, they last for about 8 days. We go to 4 markets. we go to New York, Atlanta, Memphis, and Orlando. And interestingly enough, what Brendan and I did is we'll tend to spend a week before examining other markets. So we went, in this time, we went to Phoenix and to Vegas. Next time I'm going to go to California because I think there might be some opportunity out there. And I'd like to look at Texas as well. So we're constantly looking at new markets. But for now, those 4 markets are what we believe the best markets. They've got the best fundamentals. We've got the best information. And most importantly, we've got the best partners on the ground. The timing of those trips, the first trip next year is the first week in February. The second trip is at the end of April. The third trip is at the end of July. And the last trip is in the middle of October. So if you want to come out, come and experience it yourself, fantastic. But do understand, if you don't come out, 70% of our clients still buy sight unseen, without actually coming. But for those of you who can't make it, for those of you who are too busy, the USA Investment Extravaganza, we're going to bring America to you. So we built our company years ago on taking the South African experience to London, the London experience to South Africa, the Australian experience to South Africa, and now it's time to bring the American experience. And in the second week of March, we're extremely excited next year to say that all our partners are coming out. You'll be able to meet them. You'll be able to meet the currency guys, the lawyers, the accountants. You'll be able to meet the management agents, the guys that are finding the properties, renovating, maintaining, managing, so that you can literally walk in and in one day in Pretoria, Joburg, Durban, and Port Elizabeth, you'll be able to come in and meet absolutely everyone, set up a structure, move your money, find the right property opportunity. So for those of you who don't want to come to America, we'll put that in your diary for March. But I just wanted to show you, if you go to this link, and I will send all these links after this email, but ipsinvest.eventbrite.com, that's where we have all our events up there. You'll see all the dates. You can understand exactly what's going on. And, if you're interested in the buying trip, someone like Vikesh, I think it was, asked the question, Michelle will be able to help you, give you the full itinerary. And most importantly, just remember with our buying trips, they're free. We make no money out of the buying trip. You pay cost for your flights and your accommodation. This trip cost about 30,000 Rand. We're there to help you find the property. And I always say there's 4 things that we're trying to achieve out of that buying trip. We're helping to give you the right information. We're helping you meet our partners on the ground. We're helping you take action and get involved. And lastly, we're helping you have lots of fun. And to show you the fun, I thought I would share with you some pictures quickly. This here is actually Dolph de Roos, and he took us to the auctions. This was in Phoenix. And if any of you, I would highly recommend going on YouTube and looking at some of my videos of the auctions. It's absolute chaos. Anyone that thinks that they're going to walk in and buy a property and on discount at the auction is an absolute fool. I mean, look, this one, sophisticated. He's got all his buying sheets there. He's on a telephone. This guy here, sophisticated, on a telephone. This guy here, sophisticated, on a telephone. Look at this guy on a telephone. This lady on a telephone. Why? Because they have all the information. They're reporting back to buying teams. Ladies and gentlemen, you are not dealing with individuals anymore. You're dealing with sophisticated property funds. And if you don't have the right partners on the ground, there's absolutely no ways that you'll be able to take advantage of the market. But we also had lots of fun. This is Marius and myself and Brendan. We hired a helicopter. We flew out of Vegas, which was absolutely fantastic. We flew over the desert. We flew over the Hoover Dam. And we flew down into the Grand Canyon. We flew through the Grand Canyon like Airwolf, like literally awesome through. And then we landed at the base of the Grand Canyon. Check this out. We were having champagne literally down by the river in the Grand Canyon. What an absolutely amazing experience. Dolph took us out to one of the most amazing shows. This was actually in the Wynn Hotel. For those of you who've never been to Vegas, it's one of the most incredible places. We watched a David Copperfield show. We went to this amazing show with lights and everything. I mean, I was actually, funny enough, in Sun City about 3 weeks ago, and I said to my wife, what an amazing show. Well, in comparison, it was like a school play. I mean, it was unbelievable how good this was. And ironically, I actually organized comps to the best nightclub in Vegas as well. So some of the people there were farmers from the Eastern Cape, and they'd never been to a nightclub in their life, and they ended up going to the best nightclub in Vegas. This was the tour in Atlanta. So this is actually all of us in our bus driving around. And funny enough, this is one of the investors actually bought this house in Atlanta. So really, really nice house in a good suburb. This was all of us. Some of the investors wanted to open bank accounts. So this was all of us showing off our skills. It took us about 7 hours, but every single person walked out of there with a personal and a business bank account for the Bank of America. So we thought it was pretty cool with the American flag in front of their safe. And then we had dinners. Every night in every city we had dinners. So this is all the investors sitting around the table. This here is Todd. Todd is our accountant. That there is Ray. Ray is the guy that finds all our property. And down the bottom here you had Lyle, who is our lawyer. And we also had Francisco over here that was the management agent. So rather than drive around and have to sit, you know, in 4 or 5 different meetings, we just invited everyone to dinner. It worked absolutely phenomenally. In every city, you got to meet all the partners, so you knew exactly who you were doing. And I think one of the things that really I pride myself on in what we're doing is we got complete transparency. We've got nothing to hide. We want to share our partners with you so that you can equally be successful in the market. Steve has said, yes, California has excellent yields. So, Steve, I'll be coming along to find out. Andre said, in a nutshell, why America over any other country? It's a very interesting question, Andre, and it's a difficult one to answer tonight, and I'm conscious of the time. But I've invested in London and Australia and South Africa and now America. And for me right now, you know, there's with property, there's always a good and a bad time, and one has to follow timing. I own a lot of property in London, but for me right now, the London property market after the GFC lost 15%. It then recovered by 17%. You're now buying property in London at full market value, and yet you've still got the Eurozone crisis. You've still got the sovereign debt crisis. 70% of the British economy is based on banking or insurance, which is very transient. And interestingly enough, with the UK economy has gone back into recession. So for me, one of the things when you look at London is that I'm buying property at full market value. There's no discount whatsoever. I am getting good yields, which I like. But for me, there's higher risk involved because I'm buying it at full market value. Australia's steady Eddie. You know, the Australian market never lost anything. They dropped their interest rates from 9.75 to 3% in 4 months after the global financial crisis. In 2009, the market grew by 8.6%. Interestingly enough, in Australia, it's steady Eddie. Supply and demand is in kilter. My only thing is that in Australia, you've got FIRB, which is Foreign Investment Review Board, which means you can only buy new, so you can't buy discounts. And right now, just considering the 3 first world markets, and sorry, when I invest out of South Africa, I think South Africa is an amazing country. I think there's great opportunity in South Africa. I think it's much easier to make 8.5 or 9 Rand than it is to make $1. But when I take my money out of South Africa, I see no point in putting it in other emerging markets like Mauritius or Zimbabwe or Cyprus. It makes no sense to me. There's as much risk in those markets. So I focus on first world countries with first world assets and first world income. Also where the rule of law when it comes to property stands up. In America, if your tenant doesn't pay, they're kicked out within 3 weeks. They cannot believe that we have tenants that we can't get rid of. It's just, you know, and that's what I like about those markets. And for me right now in America, I'm buying stuff at 50% of replacement value. The yields are net 10% plus. And, you know, you just can't compare it anywhere else. The downside, other than places like Memphis and stuff, I can't get financing. But that's also a pro, because when financing becomes available to the man in the street in America, that's when the opportunity will die. So I want to take as much advantage, get as much property in America now while the opportunity is good. And the main reason for me is we've got great partners on the ground to be able to take advantage of that opportunity. Interesting enough, here's a picture of our team. John said, thanks for stimulating sessions, some great ideas. Afraid I have to leave. No worries, John, you can watch the rest of the recording. Alex said, how easy is it to refinance properties? As I said to you, Alex, it's difficult. Other than in specific areas where we actually have financing up front, we don't know when the banks are going to change. But it is possible to finance once your LLC has a track record in terms of where you actually are. So this was us actually in Memphis. It's a street called Beale Street. It's one of the most authentic streets I've found in America. All got blues music and live music and absolutely awesome. We had a great night in Beale Street. And then believe it or not, that's actually me. That's 2 of our clients, basically Michiel and Dustin. And we were in New York for Halloween. And, you know, the Americans absolutely go to town. And so we thought, well, if you can't beat them, join them. So this was us in New York dressed up for Halloween, and we had an absolute joy. So, you know, we had a fantastic trip, and someone actually asked about testimonials. I will send you a link with all these testimonials. They're all on YouTube. Just do a search for USA Buying Trip, and you'll see all the people that came. We had phenomenal feedback from all the people that came. They absolutely loved it. They loved the experience. They met the partners on the ground. They got the right information, And the great thing, the thing that makes me most excited, is that they all took action. All of them left America having invested in property, understanding the opportunity. And one guy who's actually a CA who's worked in London, New York, and Sydney said to me, and I think it was classic in the testimonial, actually said to me, he worked in New York for a year and a half. He thought he understood the opportunity, but only when he came on this trip did he realize how great the opportunity is in America. And now he's realized he didn't come with enough money and he has to go home to get more money. So in conclusion, there's all our contact details. There's the website for IPS Invest. There's the website for Wealth Migrate. You've got my email. You've got the numbers, our telephone number, our blog, which we keep up to date with all the information. Twitter, I try and update you. YouTube, that's where all our videos are. So all the videos we put up there, all the different properties and everything else, a lot of the ones I've been telling you about, although I will send you the links. And then Facebook, we try and keep you updated on. And I just want to finish off with the story, basically. And the story goes that the two clients actually trusted one of my partners, Brendan, and invested overseas in America, funny enough, in Atlanta. And interesting enough, it's a huge thing to do when it's sight unseen. But they took that leap of faith, and they actually still came on the buying trip because they wanted to come and they wanted to meet the partners and they wanted to see the opportunity. And I think what they experienced was there was a lot of intrepidation when they were in Atlanta driving around. What's their property going to look like? And when they saw their properties, I think they might have even said, well, maybe, if we were here, we could have found one that was slightly a little bit more unique or slightly different. But when you're dealing with investment properties, they bought those properties at around $85,000. And by the time we were there in Atlanta, the prices were around $105,000 for the same quality product. Now, considering they bought two properties, they've saved themselves anywhere from $30,000 to $40,000. And the point of why I tell you the story is that the market is turning, ladies and gentlemen. When we were in Atlanta in April, the average price was about $65,000, $75,000. When I was there in August, it was kind of $85,000, $90,000. When we were there now, you're looking at closer to $100,000 to $105,000. Those clients that invested with us in August have already made at least 10, if not 15% on their money. The clients that invested in Orlando, they've made at least 10% on their money. And the Memphis guys are enjoying, the great yields in terms of where they actually are. And on top of all of that, since August, the Rand has lost 10%. So if you look at two trends, one is that the Rand is devaluing. And I've shown you scientifically what I base that upon. And if you want to go and watch the webinar, please go and watch the webinar where James goes into a huge amount of detail. But the bottom line is it's going in one direction. The other problem is that the market is recovering in America. Warren Buffett came out today, if those of you follow LinkedIn, and said that he's buying up estate agencies. He has confidence in the market. The market has turned. Things are happening. And like Gary said, some markets are slower than others. We understand that. But the point is the market has turned. And that gap between being able to buy is getting more and more difficult. And I worked out that those people that took action in August versus those people that took action in November actually saved 24%. And if the trend continues to stay the same, those people that wait till February, it'll cost them a further 26%. But that's a decision you have to make. Whether you want to take action now, you can. Our team is here. Brendan, Teresa, Relene, myself, Kristen, we've all been there. We've seen it. We've touched it. We've worked with the partners. We've helped over 2,000 people invest internationally to a value of 1.6 billion Rand. We pride ourselves on the fact that last year, 78% of our buyers were repeat buyers. Why? Because our ability is to find the right information and get you the right partners. So on that basis, I want to thank you very much for tonight. It's been absolutely awesome. I hope that the information that I've shared with you has been valuable. Hopefully now you understand finance. You can no longer have the wool pulled over your eyes. I've hopefully, helped you unweave the truth so that you can understand what is possible and what is not possible. And if you go into a finance deal, awesome, but go in with your eyes open. And most importantly, ladies and gentlemen, please understand this opportunity. Understand that you can get involved, but also understand that this opportunity is not going to be there forever. So on that basis, if there's any questions, please let me know. I can see that Yaku said thanks. Andre said great webinar. Just sorry I missed the buying trip in October. No problem, Andre. Come with us in February. We had an absolute blast. All of us were there, and we're planning even bigger and better one in February, because obviously we're learning as to what works and what doesn't. But for those of you, get hold of us, whether it's direct property, whether it's Wealth Migrate, whether it's a buying trip, I don't mind. But most importantly, do me a favor, if you enjoyed this evening, spread the news. 80% of South Africans that invest overseas lose money, and I'm sick and tired of it, because they get the wrong information and they deal with the wrong partners. And all that I'm trying to do tonight is educate you so that you can make informed decisions, you can invest with confidence, you can have wealth preservation, a plan B, and peace of mind. Good night. Just a quick question here. They're still coming through, so I'll stay online while people are asking questions. Steve said thanks. Mark said interesting. What is the next step on Wealth Migrate? We'll send through the emails. Gary said thanks. Robin said thanks. Vikesh said thanks. Frank said thanks. Sorry. Everyone, there are lots of thanks here. Ian said, what is in this for you? Money. 100%, Ian. I help people invest in international property. In fact, I've got a principle. I built my entire business. We've been doing this since 2003, and it's actually on Zig Ziglar's principle. You can have anything in life that you want as long as you help enough other people get what they want. So my philosophy is I'm investing in America right now. I want to share what I'm doing, and by helping you invest in America, I can invest in more property. So hopefully that answers your question. Andre says, very polished and well done. Please call me when you're in Cape Town so we can meet up. Perfect, Andre. I'll be down there. I'm driving down on, I think, the 17th or 18th of November, and I'll be there for Christmas to do lots of kite surfing and enjoy the weather. But no, seriously, any time from the 18th of November, I'll be available. Sully says thanks, and Andre says drive safe. Gary says, when are you in Durban next? Very good question, Gary. It'll probably have to be early next year. I don't have a trip booked to Durban for the end of this year. But what I'd suggest, if you are interested, let's set up a one-to-one Skype meeting or webinar, and I can run through everything and understand what it is. Why too much rain? What does that mean? Sorry, too much rain in Durban. Well, funny enough, Gary, I'm actually a Durban boy, born in Kloof. I went to school in Kearsley, and my mom actually moved down from Durban to Cape Town end of last year. So unfortunately, from a family perspective, there's not too much reason to come there. But from my investor's perspective, I will be there. But my trip will be in the first quarter of next year, probably February sometime. Okay, and Andre says, Stormers, yeah, we won't get into the rugby. I was conveniently in New York when that was taking place, so I unfortunately couldn't watch the game and haven't chosen to watch the replay either. And Gary says, we forgot what the sun looks like. So anyway, ladies and gentlemen, if there's anything else, let me know. Please get hold of me. It's been an honor and a privilege having all of you online tonight, and I look forward to helping you in the future. Marco said, missed most of the webinar. Where's the best place to start? Marco, I've recorded it, so I'll send you the YouTube link. Alex says, do you have enough props for sale? Do you always? Oh, Alex, we're not an estate agent. We don't have 20 properties available. We're an investment company. We understand what investors are looking for, and then we find the opportunities on the ground. But our guys on the ground are excellent at finding opportunities, and we haven't had a problem yet. Ian J says, minimum I can start with. Ian, if you're looking to buy a direct property, you're looking at about $40,000, $35,000, between $30,000 and $40,000. If you're looking at Wealth Migrate, it's about $15,000. And Andre says, please send the YouTube link to this one, Andre at CR. Okay, Andre, as long as you registered with that email, I'll copy all the registration emails and send it. Okay, are there any other questions, or can we call it quits for tonight? I'm very excited, Andre, to let you know it didn't storm in Joburg. I'm sitting out on the balcony on a nice Joburg evening. I was worried it was going to storm on top of me. So anyway, okay, I think that's all from everyone. If you do need to get hold of me, you've got my email, you've got my number. Send me everything, and we'll be able to assist. Thank you very much. Cheers. Bye-bye.